Have you ever bought a call or a put, were right in the direction of the stock and still lost money because of what we call the IV crush or implied volatility crush? And the implied volatility crush is a natural phenomenon that happens very often. That's why in this video I wanted to cover how to avoid to be hurt by the IV crush and how you can even take actually advantage of it. And if at any point you find this video helpful or interesting and you actually learned something, please consider subscribing to my channel and liking this video. That's really the best support you can give me and I really appreciate it. And if you haven't heard about the implied volatility crush, the implied volatility crush refers to a sudden drop in the implied volatility, proof of a sudden drop in the option prices. And the implied volatility, as a reminder for those who might not know, is a reflection of option prices, meaning if option prices are going up, the implied volatility will go up, and if the option prices are going down, the implied volatility will go down too. So when does an IV crush happen in the first place, and why does it even happen? And usually IV crush is often referred to the earning events, meaning that just after a company releases their earnings, that's where we tend to see what we call this implied volatility crush. But why does that happen? Let's say that you want to trade Netflix earnings, you think that Netflix is going to go up after the earning event because they apparently have great results, and you have some information and you think the stock is going to go up, so you buy a call. But you can imagine that you're not going to be the only one trading Netflix earnings, and there's going to be a lot of people actually trading options during that time. That's something that we can expect. But when a lot of people are actually willing to trade certain options, when a lot of people are willing to buy certain options, do you know what happens to the price of that option? It increases, and that's what we call the law of supply and demand. When there's a lot of demand for a certain asset, for a certain product, the price of that same product is actually going to increase because now there is more demand for it. And on the contrary, when no one is willing to buy a certain option or a certain product, whatever it is, the price of that same product is going to decrease because now there is less demand from the market. But remember that the implied volatility is a reflection of option prices, meaning that the higher they go, the higher the implied volatility, and vice versa. Well, if a lot of people are willing to buy options, the price of those options are going to increase because now there is more demand, and so does the implied volatility. Because the option prices are actually increasing, there is now more implied volatility for that stock. But think about it. Now that you bought your call, you bought your put, the prices of those options are super expensive, the earning even happens, and let's say that you were right even in the direction the stock actually goes up. Now that earnings are actually released, there is no point in trying to buy options anymore, because if you wanted to buy an option, that would have been the day prior to the earnings. So now there's no point in buying options. And what happens to the demand now for those options? It's actually decreasing because now there is no point now in buying an option or a put or a call because now they even actually happen. So what happens to the option prices now that there is no demand anymore? They decrease, and so does the implied volatility. And one particularity, for example, of earning events is that the drop in the demand is usually very sudden, making option prices go down very suddenly, and so making the implied volatility crushing very suddenly. Hence why we talk about IV crush. Now that we understand this, now that we understand that the implied volatility crushes because there is less demand for those options, how can we avoid the IV crush? If you want to avoid the IV crush, you basically have two options in front of you. If you really want to buy an option, you will need to buy your option prior to the earning event, several weeks before, so as to benefit from the increase in the demand for those options that you're willing to buy. By buying options way before the earning event, you're going to benefit from the increase of the demand for those options, and so you're going to experience the increase of those option prices, and so does the implied volatility. If we were drawing the implied volatility for that stock in particular, we would see that several weeks before, we're going to see the implied volatility that is going to increase and increase slowly but surely up to the moment where the earning even happens, and all of a sudden the famous IV crush. So if you were willing to buy an option, it makes sense to buy it several weeks before, because at least now you're benefiting from the rise in the implied volatility being a proof of the rise in option prices. And the second way to avoid the IV crush is actually to benefit from it. And to be able to benefit from the IV crush, you need to take the other side of the bet. You need to become an option seller, because we know for a fact that this IV crush is something that happens over and over and over again. So what if instead of buying an option prior to the earning event, you were selling an option? Because we know that there is so much demand just before the earning event. If you sell an option just before the earning event, you're selling an option when the demand is at its highest, when the option prices are at their highest. And because of the IV crush that is happening very, very often, you are benefiting suddenly from a drop in the demand, and the option prices are going down, and which is exactly what you want want as an option seller. You want the option prices to go down so you can buy back your option at a lower price and make the difference in profit. That's shorting. So this IV crush is now becoming your best friend. And if you look at certain trades that I've taken, if you are in my Facebook group Option Trading 101, and you'll find the link in the description, you'll see that I very often post the earning trades that I take. And if you look at, for example, the past trades that I've taken, whether it's on Wells Fargo, Morgan Stanley, or American Express, you see that this pattern happens over and over. You see that I sell an option just before the earning event and actually take advantage of the IV crush and buy back my option the next day when the market opens. And if we take back the implied volatility curve for the XYZ stock that I've done before, you can see that now when you sell an option just before the earning event and you buy it back just after, you see that now we're benefiting from this drop in the implied volatility. We're benefiting from the drop in the demand. And that's where now the IV crush actually comes very handy, because now it becomes your best ally as an option seller. So now you have two ways that you can use to avoid being crushed by the IV crush. You can whether buy options but further out before the earning event so as to benefit from the rise in the demand of those options and sell just before the earning event, or sell an option just before the earning event and buy it back the next day for a lower price, hopefully, because the option will have lost value because of the IV crush. Personally, I prefer to be an option seller. I think it's simpler to take advantage of this natural phenomenon, which is the IV crush. But if you want to buy options, this is definitely possible, and you can, for example, buy options before the earnings several weeks before and sell just before the earning event. And after that, it comes down to what you want and what you're looking for in trading. Maybe you prefer to buy options, maybe you prefer to sell options, but this video was just to show you on how you can avoid being crushed by the IV crush, as we say, no pun intended. And I hope this video was helpful for you, and now you understand a bit more on how you can avoid being hurt by the IV crush and how you can actually take advantage of it. And if you've been watching until the end of the video, I really thank you very much. I hope you really enjoyed it, and I'll see you in the next video, and in the meantime, I wish you all the best.